All right, what up, YouTube? Let me know how the sound quality is. Hopefully I got this thing set up right. Still out of town. We're going to be doing this off schedule for a while. But here we got the S&P 500. And despite all the fear that we're hearing in the market, you know, about whatever it is, student loan repayment, markets pulling back, you know, the bears, Michael Burry's short puts $1 billion, whatever it is, the S&P has a lot of support. All we've really done is pulled back into the support. Okay, we pulled back into support. We can obviously see that, right, from what is this, back in June. So in mid-June, we put in a resistance level. In mid-June, we put in this resistance level, right? You can clearly see it mid-June. And what are we doing? We're basically testing that level. So on a technical basis, the market is still in a bull trend. On a technical basis, the market is still grinding higher, and I still expect us to hit all-time highs by the end of the year. Okay, there's a little bit of weakness in the prices, right, in the technicals, and all of a sudden everybody's bearish, right? Of course, but you know, we're still in a technical uptrend, and we still have more layers of support to come in here. Obviously, right? Obviously, we have this 444 level, which we bounced today. Okay, 444, we bounced today on this level, and then we also have. Let's move this back a little bit. We also have the. What is this this next level? This next level is 4. I think I had it at what? 4. This was in the newsletter. 438, 437, 438. That's our next level. Let's draw a little arrow here. Excuse me. All right, so 438, that's our next level. And then obviously if we get down here, now there are reasons why we could get down here. And if you watch the stream, if you keep up with the newsletter, you will know the only way we're getting down here, right, to 431, the only way we're really going to get down here with all the macro tailwinds is if the biggest tailwind, which is inflation, the biggest tailwind / headwind has been inflation. Is it up? Is inflation doing good? Are we getting progress? If we are getting progress, all of a sudden, you know, we have the market bidding higher. So these are the 3 layers, the 3 support levels for the S&P at least, right? Looking at the S&P 500 index. Where we can find support. You know what? I was supposed to send this stream out to somebody else, but that's fine. We'll do it. We'll look it over. So these are our layers, right? 1, 2, 3. We got these at 444, and then SPX is going to look pretty similar. Not much difference there. SPX is going to look pretty similar, and see if I can do invite here. Yeah, SPX is going to look pretty similar. Now, what is going to get us down here? So the biggest bearish factor that we've seen, okay, is going to be oil. Oil is our biggest bearish factor at the moment, okay? And as you can see, oil is at a big critical level, and there's a little bit of commentary on why oil, you know, may not go higher. Oil's had a big surge. That's the only reason the only reason CPI bounced up, by the way, we had a 12-month streak. Right, a record 12-month streak of CPI coming down. That's never happened. So for 12 months, CPI came down. The only reason it bounced up is because obviously oil, the biggest input to inflation, oil has to do with pretty much everything. It's energy costs, etc. Also plastics, whatever it is, that moved up. So we had this big move in August, right? July going into August, and that made the CPI move up pretty fast. So really the question is, will CPI not CPI, but will oil get above this 83.50 level? Can we get above 83.50? Can we support 83.50 and then break out higher? If that's the case, then I do expect, you know, let's go to 10-year. I do expect 10-year yields to move up. I do expect the dollar to keep moving up, and I expect S&P 500 to the S&P and stocks, crypto, whatever it is. It's going to hurt everybody. This will crush everything if we get that oil price explode to the upside. Rates go higher, right? Growth expectations also go up, and then we reaccelerate. We need about 2 consecutive inflation prints above the previous month to actually think inflation's gonna, you know, grind higher. But we're not getting that. So far, we're getting 1 month. Wow, we bumped up for 1 month. So keep your eye on the price of oil. Okay, keep your eye on the price of oil. And the good news is, look, after a couple days, we're starting to see some rejections here. We're getting a rejection. This is the biggest risk. What up, Bukowski? What up, Slime Z? Manny, how you guys doing this morning? Yes, the dollar is also a big risk indicator. So we're going to look at the dollar. Now, I want you guys to keep your eye on this too also, right? Looking at oil, okay, just for the upside. Am I biased? Yes, I'm biased. I'm biased. I want to see things go higher, right? I want to see things get resolved, but I'm not stupid. If we get above 83.50, obviously we're in trouble. Now let's look at the technicals. We're seeing some bearish divergence, okay? We are getting bearish divergence, which is the oil price is, you know, the RSI is pulling back a little bit. So we're getting RSI divergence here, okay? That's when the buying pressure starts to slow down. And at the same time, you're getting price, you're getting the actual, so here was the peak in buying pressure about right here, July 28th, right? You're getting the you know, the price move up while the pressure comes down. That's a bearish divergence. What that signals is that there should be a correction at some point. The question is, does it correct a little bit, right? Maybe down to 79.80, which would still be pretty bullish on the upside, or do we correct back down to the support at 67? Okay, what will get us down there? We don't know. So the price of oil is showing some bearish divergence. That's positive. That means we could see a relief rally. That means CPI won't move up in the next month. If this stays where it's at, CPI doesn't move up, investors, you know, regain their confidence. Investors, you know, don't see that reacceleration inflation risk come back. Right now, the biggest risk, Bukowski, for the dollar is that inflation expectations rise. And we did get inflation expectations today, by the way. Let's jump over to that. Consumer inflation expectations came in at 3.5%. And this was for the month of July, okay? So expectations are falling. That's positive, right? We're not getting that. But, you know, you don't really see that. We play that narrative out. And so moving over to the dollar, the only reason the dollar is beating up right now, the reason the dollar is showing some, you know, some strong, you know, also the dollar is, it is moving up. It's near oversold. I'm going to say overbought, my bad. It's near overbought. So the dollar is almost at the top of the range, right? The dollar is almost at the top of the range for the RSI. If it does get to the top range, then usually you get a pullback on the dollar. The reason why that's important, because it's the easiest indicator to tell us which way, which direction markets are headed. Okay. Bukowski, also check out the trend, right? The dollar is in the downtrend. The dollar is in a downtrend, right? It topped here, right? We're still holding that downtrend. It's not over yet. We're not breaking out to the upside. I don't see that happening at all. Every time we got the dollar pull into this trend, right, and get rejected, as we are heading into right now, every time we got that rejection on the dollar, look at the RSI. The RSI pretty much peaked at the top of the range. Are we there yet? No. So the dollar, and this was the biggest move we've probably seen from the lows, right? We had that big capitulation, then we came back up. This is the biggest move to the upside. So I expect the dollar to peak out somewhere around here. It could be its interest rate risks, right? Interest rate risk has been the story for the entire bear market cycle. I don't think we're in a bear market no more. If you think, you know, a bear market doesn't end until you hit all-time highs, sure, then we're in a bear market. But for me, the bear market's over when the trend changes, when the technical trend breaks, and we got that break back in March. And, you know, we've been moving up for a long time. So this is basically the dollar's move. Every time we hit, right, for this past cycle, for 2023, every time the RSI got at the top of the range, which is buying power, right? You know, overbought territory, too much buying. Okay, relief rally, right, to the downside. Every time the dollar peaked at the RSI, it did start to respect the trend. So we should be respecting the downtrend. Maybe it doesn't happen, but the probability that the dollar respects the downtrend over the next, the rest of August, at least the next 2 weeks, maybe it trades a little bit of sideways, right? I think it respects the trend. I think it respects the top of the RSI, and we roll over from there, and the market can resume its uptrend. The market can at least find a bottom and a support, and we do know, looking at the S&P, obviously, there's a lot of zones of support here. Oops. We still have a lot of support zones here, so we're not too worried about it, right? Actually, the S&P is holding on stronger than I would have actually thought. How do I make this smaller? These things are too thick here. That's all right. So I think the S&P is actually holding on better than I thought. I thought we would have came down to 438 already, but we're holding that 444. The Qs are a little stronger, but today are a little weaker overall, but they're stronger today. The Qs, technology's catching that bid right back up, right? So look at the oil risk. If oil stays where it's at, S&P consolidates here at 444, no issue, no problem. If it goes higher, then we probably see the S&P drop to 438, right? Because inflation expectations might go up. Well, they should go up, and the dollar will go up, rates will go up, and the S&P will have to revalue itself because it is valued off the bond market. It is valued off these yields, right? The higher these yields go, the lower the return on the S&P because, obviously it's interest rates will take away the valuation. It'll hurt the valuation of the S&P. So really, again, interest rates also are a risk. But look at the RSI and the interest rates, right? We've been peaking out. Now, interest rates have been very strong, right? I think personally, Bukowski, I think interest rates right now are running up, right? Because primarily they're trying to front run the data. What data do we have, right, this week? What data do we have? We had inflation expectations come down, right? Oh my gosh, Indian inflation went up a lot. That's kind of a risk right there, right? Indian inflation popped pretty high. So that's a big move. That's a big move, right? I got to look into that. We'll put that in probably in the newsletter or update. That's not good. Anyways, going forward though, right? What are we looking for? Retail sales tomorrow, Tuesday, right? Early in the morning, retail sales we have. If retail sales come in weaker than expected, right? Month on month, if they're a little lackadaisical, if they're a little weak, then bond yields should start to peak out. Okay. We also have a couple Fed members speaking. So we'll see if they're a little more dovish. Lately, they've been a little more dovish. We also have the FOMC minutes this week. So what I think is happening is bond yields, which are very important to the stock market, right? This is basically the cost of capital, the cost of borrowing. Every company borrows money. So obviously the yields are going to matter. If the yields are higher, the cost to borrow is higher. Your earnings, you hurt the earnings, you hurt the economy, right? As long as yields go up. So the yields or the bond market is basically front running the data for retail sales tomorrow and the FOMC minutes on Wednesday. If the retail sales numbers are not strong, if they're pretty weak or they're pretty, within expectations, I think bonds will peak here. Okay. And then the market can catch a bottom. The market can start bottoming out. And I think that's very likely. We'll see what the FOMC minutes. I think the Fed is turning. The Fed is starting to switch the cycle. They're ending their hiking cycle. I think they're done at this point. From the data I'm seeing with CPI, and we're going to go over CPI. We're going to go over, what up, William? We're going to go over CPI. The data is weak. It points to lower inflation, right? As long as oil prices remain beneath that 83.50 level. Okay, so I'm telling you, that's what we're looking at. You ain't got to really worry too much unless we get above that level, because then expectations go up. Okay. So again, let's go over the other risk here. Do you think the new variant will affect us? The new variant, what that would do was, if it did shut down the economy, now you're looking for stimulus. I think the market will struggle for a bit because it's a little uncertain, but I don't think so. I don't think there's no new variant that'll hurt us. But I do think if that shuts down the market will have a correction, right? So if we do, let's say we get a new variant and there's a lot of uncertainty, expect S&P to trade all the way back down to 431, possibly even 420, right? We could come all the way back down, but during that time, you're going to see the same thing we saw in 2020, right? It's not going to be as bad, first of all. We're going to see the same thing in 2020, which is the market's going to anticipate, okay, if we got to shut down, then we're going to be looking for an excuse for, first of all, inflation is going to get destroyed. Inflation's gone at that point because you're going to shut down businesses. So yes, we'll get a sharp correction. I just don't think it'll be as low as we think, because the Fed, right? The Fed is going to now shut off their QT. They're going to stop raising rates. They might even cut rates. And that's going to be an excuse to cut rates and to restart QE. So sharp pullback. If the variant is real, I don't even know nothing about this. I haven't even heard about it. But if there's a new variant, sharp pullback, and then the market should anticipate the end of QT and more stimulus going forward, right? That's going to be the excuse to get things revamping right back up, and this inflation dragging pretty much dead in the water, right? So other than that, right, Slime Z, what sector do you think is going good forward? Yeah, we're going to go through that. We're going to go through what sectors right now. Hey, let's look at the bond market really quick. Bonds got smashed. Okay, we know bonds got smashed. They bottomed on the RSI, right? So bonds got oversold. That could have been a buying opportunity for bonds. As long as the economy stays strong, right? The RSI got a little oversold. So in this area, this was the previous area. We've seen this area for bonds, 93, 94. Bonds had some support previously there. Now, I'm not so bullish on bonds because the growth data is still pretty strong. But is it a good time to buy bonds? Maybe a piece of your portfolio. Why? Because they're yielding, you're going to get that 4% yield on your bond no matter what. If there is a recession, right, you're also going to be protecting yourself because bonds are going to bid up. If the economy starts to, roll over, which it could, then you're going to get bonds start to bid up, right? The QT ends, the Fed starts buying back US Treasuries, the bonds will go higher. So if you're going to buy bonds, if you're going to buy protection, this would be a good place to do that. Okay, down here, in my view, in my opinion, not my whole portfolio, but maybe a little piece of your portfolio, right? It really just depends, but bonds are down there. And the bond weakness is also pushing yields higher, right? There's a big bet right now to short bonds, to short US bonds. There's a big bet on there. And what that does is it pushes rates up. So where's the buyer at? That's what the question is. Where's the buyer for bond yields? We need a buyer to step in. And is it the Fed? No, it hasn't been the Fed. Is it the US Treasury? They said they might do that. Is it going to be Japan? They haven't been doing it because they're buying their own bond market to keep yields from going up. So we need a buyer to come in. China hasn't really been that buyer. They do hold bonds, but they haven't been that buyer, okay? Next, the VIX. Another reason not to worry, the VIX, the volatility index, or the insurance against the S&P is not really moving up, right? We're not seeing VIX volatility. So regardless of the bearish sentiment, right? Regardless of the bearish sentiment, well, it's what people do, not what they say. We're not seeing a whole lot of volatility, or we're not seeing a whole lot of insurance against the equity market bid up here. We're not seeing the insurance spike. We spiked up last week, right? And right after CPI came in, it was a good report. It was a good report relative to what we've seen, right? Because relative to what we've seen is we're still making progress on the core. Core came down, so we're still positive there, right? So volatility is coming down. Okay, how about Nasdaq volatility? Yes, Nasdaq volatility also is coming down. We're not seeing it really spike higher. So the market is saying, we're not too worried. We just need to consolidate. We'll come down. Here's the big positive here. The bond market, even though bonds are bidding up, volatility is not. This tells me that the bond, the interest rate risk right now is all about technical trades. It's all a technical trade. There isn't really interest rate risk. Okay, inflation is not going back up, so bond volatility is okay. This means that financial capital markets or banks are okay. There's no issue. When we see this spike, you really get an issue on borrowing. So we're not seeing that, okay? Triple B spreads, right? This is debt being bought up. Triple B spreads, as long as this goes down, or what I like to do is call this chart. So we invert this chart for triple B spreads. What is the triple B spreads? Think of it as the whole equity or stock market debt. You want people to buy the debt to support the market. And when we invert the scale, you see that since October, equity debt has been trending higher. So there are buyers, right? And what's more risky debt, Treasury debt or equity debt? It's equity debt, right? Equity debt's going to return you more than Treasury debt. So there's still an appetite for risk, right? Investors are still buying equity bonds or, equity fixed income. This is basically fixed income more than bonds. So if anything, investors are still confident in the stock market. Okay. That's what that tells me there. That's the inverted, if we invert it, right? So you really understand it's the spread between bonds and stocks. So let's turn this right back around. Okay. So we have the scale here, junk bonds, right? Whatever. The bond market is fine. The US equity bond market is fine. Okay. Obviously, we're looking at S&P 500. We have a lot of support levels. I don't see us really coming down here until oil really starts to bid back up. And then we are going to get to equal weight. What's equal weight doing? Pulling right back. Look at the equal weight, S&P equal weight. So take away the Magnificent Seven. Take away the big tech companies that everybody says this is the only reason the stock market's going higher. Take that away. We're falling right back into support here. Okay, let's make it a little more clear. Let's get this a little more clear. There we go. Okay, 150. So RSP, right? If you have TradingView, RSP is the S&P equal weight, which is a testament to market breadth or the market expanding overall, not just the big companies, not just the mega cap tech. This is a testament to all the S&P 500 companies. And that just means that the market is still expanding. We're finding support here. In the moment, we're not. We are, we're trending low over the past couple of weeks, but we know we're in seasonal weakness. We know that September, historically from 1928, is the weakest month of the S&P 500. We already know that. So that's fine. People are going to pull back, right? They're going to pull back a little bit and wait for support to form before they get back in, all right? Before we get to crypto, we're going to dissect I'm not dissect. We're going to take apart a little bit of the S&P 500 industry. So here we go. Bukowski, what sector do you think is good going forward? Well, let's look at the industrial sector, right? The industrial sector is still going to benefit from the fiscal stimulus coming in, and it still hasn't really hit. So I believe industrials still go higher. Industrials are still pretty strong there, okay? Let's go to consumer healthcare. I like healthcare. I really do like healthcare. It is a service. I'm going to drink the Celsius right now. I don't know if you guys drink Celsius, but I need a little bit of caffeine. Okay, so consumer healthcare is bouncing. Look at that trend. Very nice trend. We broke from the big long-term wedge and we're moving up. We're trending higher. The market is still expanding, right? Healthcare showing strength. Industrials are pulling back, but healthcare still showing strength. Utilities, right? This is defensive part of the market is utilities. Utilities are weak. So this is, utilities reflect defensiveness, defensive positioning. Nobody's positioning for a defensive market for a recession. If you have a recession or if you get near a recession, utilities go higher because they're kind of recession proof, not 100%. But they're going lower, so this is risk on signal, okay? Let's go to discretionary, right? Consumer discretionary, trying to find a bottom. Obviously, we have support here at the previous resistance level. We had support there back in early August. Now we're pulling back into that support. So discretionary, a lot of this is led by Amazon and Tesla, okay? So we're just pulling back. But consumer discretionary reflects consumer spending, okay? It reflects consumer spending. So as long as this holds up, it's going to reflect that consumers are still pretty strong, and we know that. We've seen that. Consumer staples, these are defensive stocks, right? So I'm not cool on I don't care about defensive stocks right now. Defensive sectors, defensive ETFs, I think they're going to be weak because we know GDP is starting to turn up again. GDP is starting to bottom out. There's a lot of buying. People are healthy. Oh, well, what about the student loan crisis? It's not a crisis. People, they're just going to have to decide to spend on whatever it is. Also, it's not like they're going to drain everything. They can decide not to pay their loans, their student loans, and it'll just stack on their interest. It's not going to stop them from spending. And later down the road, you could get some policy where it's like, okay, we're gonna relieve some of that debt. Who knows? But I just don't think the student loan repayment's a big deal. I think that it's really going to be kind of neutralized by all the dividend or all the asset income from the dollar, right? If you hold cash, you're getting 4.5%. That's going to neutralize all the student loan repayment weakness. If you're retiring, you have a lot of dividend income that's going to neutralize all the weakness. So I think we're neutral at this point, right? Go to communications. I like communications. I think communications are going to benefit, obviously, because the fiscal stimulus into communications, telecommunication networks, Wi-Fi, whatever the fiscal policy is, that's going to boost the communication sector. It's been weak for a while. So you see those are bidding up. Look at this wedge, right? This is a nice little wedge here we're seeing for communications. Wedge pattern just showing there's a lot of buyers stepping up, and it's not in a downtrend, it's still in an uptrend. So communication services are pretty strong. Banks, right? Financials still trending higher, right? That's a falling wedge, whatever. Still, energy's been pretty strong here. We know that because of oil. So this is just an easy look here. This is an easy way to look at, okay, well, if oil does head higher, let's say, the market's weak, expect XLE, expect the oil sector, the energy sector to bid up, okay? So you could hedge yourself with the, XLE ETF or some other energy type plays. I'm not interested in that because I'd rather catch the bottom, but everybody's situation, everybody's positioning, right? They might be overweight, they might be underweight. They all have different positioning. And XLE, for the most part, if oil does go higher, is going to benefit from that. The same way that it did when CPI was exploding back in the second half of 2022. Okay, I'm sorry, the first half of 2022, we saw energy prices go up. So really, this is just a proxy for oil, okay? Individual stocks maybe, but energy is pretty good at the moment. Builders, the materials ETF is pulling back. It's kind of flat. It's not really going anywhere. It's not trending higher. It's pretty flat right now. I'm not really interested. Real estate, I think real estate's going to be the weakest sector, if anything. That doesn't mean go short real estate. There's better shorts out there, but for the most part, XLE is weak. Now the home builders ETF, you look at if you did read the newsletter, we showed you that there's a lot of there's a lot of apartments being built. There's a huge supply right? A lot of construction build for apartments, and the home construction ETF has been pretty strong. It looks like it's really starting to form a wedge here at the top of the channel. Remember, this thing is breaking out to all-time highs. Okay, so this looks pretty strong. If you want to look at a individual industry, home construction is very strong. And I know there's a lot of conflicting ideas. We'll go over the newsletter, and because we didn't do that this weekend, obviously, we'll go over the newsletter and talk about that. SMH, right? Semiconductors, pulling back a little bit. I think NVIDIA is still pretty strong. I think we're just pulling back into support here, so I'm not too worried about that. And then you have KRE. Okay, KRE, maybe it's rolling over a bit. The Fed's balance sheet is pulling back a little bit, so we're going to see, are these regional banks going to have to use bank term funding program, some of that bank term funding program to keep. Look, if rates go higher, KRE is going to have some struggle, right? A lot of these banks, they hold U.S. Treasuries as collateral. Okay, so they hold U.S. Treasuries as collateral. So obviously, if bonds are falling, this is the bond market. If bonds are falling, that means their collateral is also falling. So the banking sector is going to struggle. Not JP Morgan, not Wells Fargo, not Citigroup, not the big too big to fail banks. The other regional banks could struggle here. If that's the case, if they struggle too much, yes, maybe the market struggles a little bit. But I also expect net liquidity to come back in. I expect the Fed's balance sheet to have to step back in. This thing's been negative. This is the real reason that markets are headed lower right now. That markets are not headed lower, but they're weak. They're weak because, look, Fed liquidity, this is the Fed's balance sheet. This is sucking cash out of the system when it goes down, or injecting cash, as we saw back in 2020. We saw that cash injection, and how funny, huh? We saw the cash injection, and that just so happened to be at the same time that the S&P bounced from the 3,800 level, right? And then just kept going higher. So when the Fed prints, right, more liquidity, the markets go higher. But right now, we're seeing bearishness. There's a lot of tightening mechanisms on the market. The market is pretty resilient in my view because all the macro technicals are actually tightening. Oil's up, the dollar's up, interest rates are up. The Fed's balance sheet is leaking below the lows. It's pulling cash out of the system. Equity markets should be much lower than this. What's keeping them up? A strong economy. What's keeping them up? A lot of cash on the sideline, inflation making progress, and the expectation for the Fed, right, to cut rates. The expectation for the Fed to cut rates in 6 months or 12 months, or even the expectation for the Fed to pause on the next hiking cycle. Let me take a breath here, haven't even breathed, and then I'll go through some of your comments, questions, whatever they are. Bulls are holding. Yeah, the bulls are holding. That's the story. The bulls are holding up here. Look, all the risk indicators are pretty strong. We got to keep our eye, obviously, on the dollar and oil prices at the moment. What up, Basan? All right, so South Carolina, that's where investor, let me see. Good morning, William. What up? New virus. I've heard the virus 5 times. No mask, vaccines. Took my call. Went to work last. I ain't worried about no virus, honestly, until I hear. So I think it's just scare tactics, attention, whatever. South Carolina. That's why we insuring Pfizer. Okay. I'm shooting. Most of us already like adapted. Our immune systems are fine. Okay. Oops. Fat finger shorting 4 stocks. When do you think oil will go back up? Kimberly Mitchell. Oil is up right now. So oil is up right now. Oil just made a 20% move basically from the lows. Okay, it's making a 20% move for the lows. If oil gets above 83.50, right, the future of oils, future of oil futures, if they get above 83.50, then, and support, not just leak above it. We just got a leak above 83.50. Okay, we got up to 84.80, probably 85 on some exchanges, whatever it was. Let me take this thing off. We got above that level and we got rejected, right? Because I think this whole move higher for oil from the low 67 is all political. It's all political and it's all supply side. There's no real demand for oil coming into the market right now. It's not there. This is not demand driven oil prices, okay? And I know what you're saying. When do I think it'll go higher? It'll go higher if the economy comes in much stronger than we expect. I don't think it really goes much higher. It can go higher if China really starts to reaccelerate their manufacturing cycle, okay? I don't think it happens anytime soon, but they reaccelerate their manufacturing cycle. They're going to need more oil for that to happen. India is going to need more oil for that to happen. the US is going to, okay, let's put it this way. If Biden refills the SPR, and I know that's a risk there, everybody's talking about it. If Biden refills the SPR, meaning he has to go buy oil on the market, if he does that, that's going to push the oil price a little higher. At the same time, you got OPEC, right, cutting production, which pushes the price higher. But this is supply side driven, meaning if you remove supply of something, prices go higher. They're removing the supply and the production, prices are going higher. But they're doing it because the global outlook is weak, right? Global outlook on oil demand is actually weak. We're at the end of the seasonal strength, right? The summer, we're at the end of the summer. So seasonal strength is done. We're entering a seasonally weak period for oil demand. And, we just got to watch the price. So I think that whole move from oil pushed CPI higher, right? And really, we're entering weak demand. So what are they going to do? Keep cutting supply? Well, guess what? You have 5 other nations, and I wrote this in the newsletter. You have 5 other nations who are pumping production, who are increasing to take market share. Okay, so they're increasing production to take market share. This is a little more nerdy talk, but the point is, I think oil remains under 83.50 unless you have, actually, I don't know. I really don't know. I think there's more. I think it made its move. Maybe it consolidates over the next couple months. If we do look at the technicals, right, the technicals tell us a lot. There's bearish divergence. So I don't expect oil. Hey, if I'm wrong, I'm wrong. Over 83.50, we're 100% wrong, right? Over 83.50, we are wrong. But right now, I think I'm seeing bearish divergence. I'm seeing buying pressure for oil start to come down a little bit. And the U.S. economy is recovering, but in the services sector, not the manufacturing sector, right? You need the U.S. PMIs, which is the manufacturing for, just put it this way, manufacturing leads the business cycle. And right now, our PMIs are still in recession territory. The only reason the U.S. economy is rebounding is because people are spending on services. So people who are retiring, they don't go buy goods. They don't go buy goods. They buy services, right? They're like, okay, I'm going to die in 20 years, 10 years, or whatever. I only have so much time left. I'm going to buy experiences. I'm not going to go buy a new refrigerator, a new car. I'm not going to buy all this new stuff. I need that money to last me for my retirement. So services remain strong. That's not going to push oil prices up. Okay. Alone, you need the manufacturing cycle to really come back up, and we're not seeing that yet. So we're kind of in like a weird phase where if the economy is too strong, it's a risk. If the economy is too weak, it's a risk. And I've always said we just need, a sideways economy. Just survive over the next 3 months so the Fed can pause. Just survive. Just stay above ground as the Fed pauses, as the Fed pauses, as inflation keeps making progress to the downside. And again, we'll go over that and we'll be fine. Okay, so what did you say? What about gold? I don't really have an opinion. Honestly, gold is not going to move until the Fed cuts rates, until they start. Because gold is basically a reflection. Gold moves up when we debase the U.S. currency. That's when gold goes up. Okay, it's just like Bitcoin, but Bitcoin moves faster. That's what I'll say about gold. Once we cut rates and once we start reliquefying the capital markets, mean the Federal Reserve, and that's the balance sheet right here, right? The Fed's balance sheet. Once you see global liquidity turn up, then yes, we can think about maybe gold going higher. But for now, I think gold is stuck. Where's the gold? Do I even have gold on here? Yeah, I do have gold. I don't think gold's going anywhere. Gold is basically debasement of currency. That's the only way it's going up. Okay, it's a boomer asset, right? Baby boomer asset. And I know the boomers get pissed off because they hate Bitcoin, but I'm sorry, BlackRock, the biggest asset manager in the world, is filing for a Bitcoin ETF for a reason, because the next crypto cycle is coming and it will be the strongest cycle. It will outperform stocks and everything else. But the cycle's not here. We're waiting for regulation. So that's my thoughts on gold. I think gold is kind of just it needs currency debasement. Either way, Bitcoin moves much faster than gold. China going into a new phase. Don't think we see as strong growth before. Me either. I think China is trying not to re-accelerate inflation. Look, China's inflation is negative, right? They have negative inflation on their producer prices and this is year over year, they're negative. So they can stimulate, and I don't really know what China's thinking. I'm not an expert, but when I do look at their numbers, their economy accelerated really quick from October through January, and ever since then, their liquidity actually slowed down. Let's throw up the global liquidity chart here so you guys can see what I'm talking about. Okay, global liquidity, and I'll throw the dollar up because the dollar is always an asset against global liquidity, right? And then we'll get to the stock market. We'll look a little deeper, but this is global liquidity right here, okay? Global liquidity, and I know this. If you're new, check out the newsletter. But if you're new, I know these charts are kind of like stuck together. But this is the global liquidity index, okay? And what we're looking at here is the biggest central banks in the world, right? The ECB, the European Central Bank, the Fed, the PBOC, the Chinese Central Bank, the Japanese Central Bank. And when you look at all these central banks, all their liquidity that they pump into the system or their money creation, okay? Their money creation has bounced here when the dollar peaked, right? Money creation started and the dollar peaked. So very good correlation there. And then money creation or global liquidity peaked in January. Okay, that was the big run up when China was stimulating. So wow, that's very right, coincident there, where we see global liquidity. Dang it, there we go. We see global liquidity peak, will bottom and peak when China was re-stimulating their economy. Now China's a little weak here, right? We're tightening. We're not re-liquefying anything. Okay. So global liquidity came down because China slowed down, we slowed down, but then we had the banking crisis. And what happened? Boom, liquidity went up again to back the deposits, and liquidity went, now we're back down to the lows. So this is a big tail or headwind for the markets, which is global liquidity. And right now it's pretty mute. It's pretty lackluster. There's not a whole lot of global liquidity. And until we get that to turn up, markets are going to have to trade off of earnings, and they're going to have to trade off of earnings. And we had a pretty good earnings report. Earnings season, better than expected. It's not like it might be bottoming out. It's about expectations, but it's going to have to trade off earnings and trade off the economy. And right now the economy is bottoming out and earnings are bottoming out. So that's positive. I think that's a good move there. So yeah, China's a little slow. Maybe markets move sideways for a month. Individual stocks can always do pretty good. I think Zoom earnings are coming up. What do you think about the US and Israel signing visa waiver program? I'll have to look into that. Send that on the Discord, SlimeZ. Throw that on the Discord. Throw an article in the Discord so I can read through it and see what's going on there. I really don't even know about that or what that is. But yeah, send that on the Discord. Let's see. Right now, both will do good because you said demand's low. Let it pick up. Yeah, demand's pretty low. Back down before demand picks up. Yeah, we're just kind of flat. Like everything's kind of flat right now. And I think the biggest factors we got to look at, like the easiest factor is just the dollar, right? If the dollar rolls over, then markets are going to catch a bid again. It's so simple and people make it so complicated, but this has been the correlation. Like who cares why? Nobody really knows, but the dollar's in a downtrend. Now, when that changes, if the dollar starts trending up, then obviously, like if it breaks this trend and starts going up, we're seeing something happen. And my guess is if it does trend up, that means bond yields are now breaking out. We're going to see rate. This is the rates. This is the cost of equities, right? This is when you hear earnings report, a lot of their income or EPS, earnings per share, are dependent on rates. Okay, not the Fed funds rate. They're dependent on the bond market rates. So if the bond market keeps going, and this is really kind of confusing, if the bond market rates keep going higher, it's going to crush equity earnings. This is why this is the big risk right here. Equity rates going higher. And what are the rates getting signal? What is the bond market? Where is the bond market taking its signal from? The Fed speakers. Okay, the Fed speakers, the economic data and inflation. The Fed speakers, economic data and inflation. Well, we got a pretty good inflation report, but it wasn't great because we know it re-accelerated a little bit for the first time in 12 months. And core inflation came down. So that's kind of like inflation might have went up headline, but core came down, so we're neutral. We're getting retail sales tomorrow. So if retail sales are weak, expect bond yields to come down. Expect that to also bring the dollar back down. So that's what we're looking at, okay? Expect oil to come down because if demand is coming down, if retail sales are weak, well, there's not a whole lot of fuel for the economy. We won't have a sideways economy, right? And again, the VIX isn't spiking, so no real risks here for the stock market at all. I think it's just, a lot of people made a lot of money. Look at Meta, Apple, like those stocks exploded. So of course they're going to take a breather, right? We're taking a breather here. Tesla is taking a breather, and we'll get to Tesla also. All right, I'm gonna take a look at that report. I'll pull it up. But before we get there, let me see the rest. What do you think about the U.S. Israel signing the visa waiver program? Yeah, I'm gonna look at that. Also, let me see economic data, housing starts. We get some housing data. Yeah, we get all that coming in. So now moving over, you're right, come back. Inflation is still the biggest risk. Let's keep our eye on that. We know inflation is the biggest risk. Actually, before we go to inflation, let's take a look at some of these technicals, right? See what are the technicals we're looking at here. Look, SPY is literally just pulling into support, right? So keep your eye on SPY, right? Also, you know what I like? The RSI finally came down a lot, right? This is the lowest RSI we've seen since May of, what was this, the banking crisis? This is the lowest the RSI came in since before the debt ceiling issue, right? The debt ceiling problem was, this is where we were at in the RSI. The buying pressure was this low during the debt ceiling. And this is right before we had wave one FOMO, which is the break above the 4,200 level. So RSI is where it should be. If it goes lower, it does, but watch that RSI. IWM, okay? Small caps are pulling back. You have clear support here for small caps. All right, what is that? 189, 190. Yep. The Dow consolidating at the highs. The Dow looks pretty strong. The Dow looks really strong. A lot of bottoming happening here for the Dow. Okay. You got the low back in March during the banking crisis. You got another low in May. Couple low, really strong lows here in July. And look, it's just been chugging higher. So value stocks are up, right? A lot of the value names are up, probably including Visa. Now let's go to risk assets. The riskiest of risk assets, wow, they pulled back a lot. ARK really pulled back a lot. So ARK is getting smashed here. We know Tesla's down. So ARK's getting hit pretty hard, but it's almost at the bottom of the RSI. And it did drop the support line. So that's kind of a no. You want to wait till ARK gets above here before you either buy ARK or before you get long the risk assets like Tesla and Zoom and all that. Or you could just buy the dipper, right? If you're just doing that. Apple right back below all-time highs, but supporting the previous highs. Okay, so Apple is supporting the previous high, but right below all-time highs, so it's going to consolidate. Amazon's pretty strong here. Amazon's holding up. You can see it's trending up, it's trending higher. Google looks like it's forming. Big tech looks like it's ready to make another move. This looks like it's when things start to relieve again. Once we get the Fed speak, the FOMC minutes, I think tech's going to make another run. It's been the weakest over the past out of all the indexes. The Qs have been the weakest. They dropped that support at 372. We came in at 365. The next support is around 360 and 357. I think is the lowest that it goes if the macro remains where it's at. See Netflix supporting. Man, we're just breathing here. The market is breathing. The market is really just breathing. It was a peace treaty. Okay, it was a peace treaty. Okay. Yeah, let's see what that says here. Oh, I don't have a Wall Street Journal subscription. Well, that's gay. Saudis agree with U.S. on path to normalize kingdom ties with Israel. So what would that do? The Saudis agree with the U.S. to path to normalize kingdom ties with Israel. Saudis and the only thing I could think of is there's some type of deal where the U.S. is like, hey, can you guys stop cutting production? Can you guys increase production a little bit to get oil prices down? That's the only thing I could think of. But other than that, I don't know how big of a risk that actually is. Okay, I really don't know if that's a gigantic risk or not. I'm going to jump over to here. Okay, the melt up to all-time highs. If you're not familiar with the newsletter, this is our newsletter. Came out yesterday, and I want to quickly sort of kind of go through what this is or what we're looking at here. What's the what are the risks to the markets, and then we'll move on to the next segment. I'm still holding Teladoc, yes. Only one contract. I'm not, like I said, I want to hold it. You never know. It's a small position, so I'm not really, You know, I'm not buying anything. I'm just chilling right here. If anything, I might buy a Tesla call because Tesla's pulling back sharply and Tesla is showing a lot of, watch, let me show you what I'm talking about. Tesla is ripping lower. I think you got to go to like the 30-minute chart to really see this, but it's very sharp, right? For Tesla, very, very sharp. And I'm gonna have to go to the TOS trading charts to see this, but it's coming. It filled the gap. Like we filled the gap. Dang, Tesla got lower than 235. I didn't even see that. We filled the gap at 235, and now we're coming. So it did fill the gap. So Tesla filled the gap, and basically, right, you got a sharp pullback here. You get the sharp wedge that's been falling for a while. So sharp pattern there, pulling into support. So I want to see the support and then the break of trend, and then move higher. So I'm actually looking at Tesla right now, probably the 250 calls, January 2021. That's what I'm looking at. I do want to see the S&P show some strength. I want to see some positive data, the FOMC minutes. I want to see how the market reacts to the FOMC minutes. And you're going 3x bull on Tesla? Heck yeah. Okay. Yeah, Tesla's still a monster, right? We're just on pause. You don't get great news all day. I know there was a production cut on Tesla. They said, oh, they cut production in China. But I do have, and if you haven't followed me on Twitter, check me out on Twitter. I always retweet really the dudes that I like. I always retweet them. And I think the latest retweet was this dude from Gary Black. There it is. Gary Black addressing the Tesla cuts. Right, he was addressing the Tesla price cuts in China. Where is it at? Well, I guess it's just on mine. So what he was saying is that the media headlines about Tesla China Model Y price cuts failed. And this is all about margins, right? If they keep cutting prices, then Wall Street's going to sell Tesla off. There's not going to be a Wall Street bid because Wall Street's looking for the bottom of margins. They don't want margins to slip anymore. They're at 18%. They were at 27 at one time, right? But he's saying that those price cuts only apply to about 18% of Tesla China Model Y volume. So only a small portion, a fifth of the volume is actually going to receive those price cuts. And we still have a whole quarter to go. And guess what? If deliveries increase, well, that's a positive, right? If these price cuts help deliveries, then you're pretty, you're well off. And it all comes down to rates coming down so that they can increase their prices again. Best-selling car still Model Y. 82% of China Model Y volume was unchanged. So yeah, I mean, I don't buy in Yuan, but basically annualized earnings impact new cuts just 35 cents per share, blah, blah, blah. Okay, 3.5 cents. Okay, whatever. Anyways, he says, we expect zero incremental Tesla volume as a result of cuts since China competitor will likely match them. China's competitors will match them. China EV consumers may wait for further cuts. So it's pretty much a nothing burger. It's just giving us a little more insight to, okay, only 18% of the volume is getting cut, not 100% of the volume. So don't freak out there. No reason to freak out. I'm looking for that reversal for Tesla for sure. Will ARK ever see 3 digits? If rates come down fast enough, maybe. I wouldn't bet on it though. If all the innovation platforms do what what ARK thinks they can do, not with ARK. If all the innovation platforms that they're investing in become the new Nasdaq, right? The new innovation fund, then yes, ARK will likely see. ARK can move. When ARK moves, it moves. But what you really need for ARK to move is lower rates. You need more investment into innovation. Okay, and right now with high rates, it's hard to invest in innovation because it's too risky. But guess what? When you can borrow money for free, it's not really big of a risk. So the risk is too big right now for ARK to really catch a bid. For those investors who don't believe in innovation as much, for anybody. Hey, the S&P is finding support at the 50-day, so I forgot to mention that. We are at the 50-day moving average. Let me throw that SMA on there also. So we have support. Look, we're at the, oh, this isn't the daily chart. This is the monthly. So let's see what it looks like today live. Yep, we're right on that 50-day moving average. Nice. So 50-day moving average, and guess what? We've seen this We've seen it support the 50-day. I think we broke above it back in March following the banking crisis, following the Fed injections, and we've been holding it ever since. Okay, 1, 2, 3. You could call it 3. It didn't touch exactly, but we've been supporting that level. Now here we are again, pulling into the 50-day. Hey, we might drop it, pull into the 100 daily moving average, right? But we still have a lot of support. So you have a lot of news. Even if news isn't so great, there's a lot of levels for investors to come and buy in, okay? So again, this is it. We just talked about this, right? The dollar is still trending lower. It's approaching reversal territory. So the dollar is approaching reversal territory. Not too worried about that. Was Palantir after earnings drop a good time to be bought? If you're scaling in a long-term position, heck yeah, I like that drop. That was a really good drop. As a trade, no. As a trade, no, because you want to wait for a little more confirmation. But if you're buying something for the next 3 to 5 years, if you're trying to hold something, you want to buy extreme weakness. And Palantir showed extreme weakness. I would say that was a buy, especially at 15. They still have a really good balance sheet. Oh, you're in JD? Okay. Okay, JD. Here's the whole thing about crude oil also. So basically crude oil jumped 20%, blah, blah, blah. Oh, here it is. So the US, Iran, Iraq, Nigeria, and Venezuela are all increasing supply. We're increasing our supply. So that is a negative force against oil prices going higher, increasing supply. So it's kind of mute. Okay, it's kind of mute right now. It's yes, they're cutting supply and then we're increasing supply. So as long as we match the supply of OPEC's cuts, then I don't think oil has a chance to materially hold higher. Okay, I don't think so. And the more that OPEC cuts production, the more they offer market share to non-OPEC countries, or the more the countries within OPEC, it's not like they're all working together completely. Some of them might increase their production a little bit to steal that market share, and oil prices go lower. So keep this in mind, right? CPI fell for 12 straight months, longest streak in history. Longest streak in history. Keep that in mind. So all of a sudden CPI bounces from 3 to 3.3. Well, guess what? Duh, at some point it's going to bounce. Okay? And this was the longest streak in history, which tells us that it's falling like a rock. Okay, it really is falling like a rock on the headline. All right? Now, not oil, but energy prices here in orange, this is below zero. We're negative. So energy prices are negative. Not prices, I'm sorry, inflation, consumer price inflation, meaning because oil prices are negative, the prices of gasoline are actually coming down for the first time. Okay. They've been coming down actually for a while, but they're actually coming down. So that's disinflation, deflationary for energy prices, not just oil. You take in all energy prices. The biggest component here, which we're always focused on, is shelter in purple. Shelter is still sticky. Shelter is still pretty sticky. Food's coming down a little bit, but shelter is really sticky. And this is all relative to the stock market. So I know people get pissed off and say, but my eggs and my meat and the prices of things I buy are still elevated versus 2020. Well, yes, but inflation always goes higher. And yes, it went up higher over the last 3 years, but relative to the stock market, right, so did asset prices. So the market just wants prices to come down at a rate of change slower. We want inflation for the stock market to be at 2.5%. So we want things to inflate at 2.5%. So stocks can inflate at 10%, right? So this is for the stock market. This is not for the economy. Yes, your pockets are going to be worth less because inflation's up. But guess what? If you're holding cash, you're going to be yielding 4.5%, which pretty much takes care of that inflation to some degree. It's tricky. Okay. So here's this important. So look at the cost to buy a home now is, this is from the BLS, Zillow, Case-Shiller, price index. The cost to buy a home on average, $27,000 a month. $2,700 a month. Really elevated. Cost to rent, $1,850. Still elevated versus historical prices. But what does this tell you? There's going to be more demand to rent than to buy, because renting is way cheaper. I mean, we're talking what, 30, 40% cheaper to rent. So maybe 25% cheaper to rent. So that's going to cause more demand for rents. And if that is the case, then we should have, we should see more supply of rents because, the home builders are saying, oh, people are going to start renting. So let's build more multifamily homes, right? And then we do see, right, this chart goes all the way back to the 70s. You're seeing multifamily housing units explode under construction. So expect more apartments. I see it in my cities. There's a lot more apartments being built because those mortgage rates are now, in some places 8%, just way too high. All right. And that's why rent prices will fall, where shelter prices might stay, home prices might stay elevated a little bit in certain regions, but we should see apartments start to really, really fall and that shelter price come down from inflation. All right. More supply, lower prices, lower CPI. The market's going to be happy. And then producer prices, they ticked up also. I know that was a negative, but they're back in historical norms. The gray area is historical norms. So producer prices for core and non-core are still really, really low. Look at core actually fell deeper. That's crazy. Core actually fell further. Or did I get that upside down? Oh, maybe I did get upside down. So I messed this one up. Stupid. Should have had the button here. No, here's core. I messed that up. Either way, back to historical norms. We're back below the 4%, right? We're back below 4%, somewhere around 3, whatever. We'll see where it goes. So we'll keep our eye on producer prices. We'll see where they head from here, right? Commodities, a lot of people are bullish on commodities, and if that's the case, then some producer prices might lift a little bit. So we'll keep our eye on commodities. I still think oil is the biggest factor there. This next one is final demand for services, right? This is also month-on-month PPI. So producer prices month-on-month. All of the strength for producer prices are coming from services, which is also what's strengthening the economy, services, okay? All right, and this is more inflation stuff. If you annualize it, we're at 0, less shelter, blah, blah, blah. Okay, it's just a bunch of, 3-month annualized coming down. So depending on how you measure inflation, it is coming down. This is the scary chart. Oh, CPI core services look like they bounced. Okay, for a month or two, we'll see how that holds up. Bond yields, we just talked about that. If these stay elevated, that's going to hurt the macro. The good news is short-term rates are actually not going up as much. It's mostly the long-term rates, but it's still not a good, in general, still not a good deal. Okay, RRP liquidity for the SPY. We're going to go over that right now. Reverse repo facility. Global net liquidity is coming down. Fed balance sheet coming down. That's a big factor to why the market is struggling. This one's big. Atlanta Fed GDP now cap. So although there's less liquidity for capital markets, the economy is actually expanding, right? Obviously, you've seen this is 2022 Q4, Q1 for 23, Q2 for 23, and then this is Q3. We're in Q3 right now. So August is the third quarter for the economy. We're in the third quarter. And right now, the third quarter is stronger than the second quarter and also the first quarter, right? So what does that tell you? The economy is starting to rebound. Consumer confidence is rebounding, okay? Earnings and margins are starting to rebound, or at least they look like they're starting to bottom out. So earnings are bottoming out. Revenues are lower, but the bottom line, right, companies are able to retain those. So that's good. And I know it's a complicated chart. We'll go over it in a second. So yes, progress on inflation, the economy is recovering, earnings are starting to recover, investor confidence is going to go up, and we see another melt up to all-time highs. Let's go. I think that's the case. I think we're going to see that. So I wanted to show you guys this money market fund liquidity. Do I have it on here? Yeah, here it is. Here it is. This is a real important chart here, and it matches the S&P 1-for-1. So what we're looking at here, let's get rid of these arrows because obviously that's the support. What we're looking at here in the blue is this is liquidity that's coming into the market away from the Federal Reserve. Okay, it bottomed down here. So there's trillions of dollars that went into the Fed because of the inflation risks. Okay, but that money is starting to leave the Fed and come into the market. So I'm keeping my eye on this liquidity. This is basically cash that exited everything, that exited the banking system, it exited the stock market, and it went and it parked itself at the Fed right? But now it's leaving the Fed and coming back in because we're in a bull market, right? Well, a lot of people believe that. So that money is going to, obviously it's incentivized to leave the Fed because stocks are going to return you more than holding it at the Fed and getting 5.5%. Okay. Now, if you have a recession risks coming in, then, this liquidity will go back into the Fed because it's like, why would we hold stocks if earnings and the, the economy is going to fall apart? There's going to be lower earnings, then maybe we won't. But right now, the economic projections are going higher and they're strengthening at a faster pace. So the economy is rebounding, right? A lot of it's from fiscal policy. So I expect this cash. I'm watching this cash right here. I'm watching this cash. This is the reverse repo facility cash. If it keeps going, if this chart keeps going up, then that's our signal that liquidity is now starting to come back into the stock market or maybe even the bond market, but it is leaving the Fed. We just want it to leave the Fed and support the pipelines inside the financial system. That's what we're looking for here. So Bukowski heard U.S. made a real deal with Iran. They might increase oil output. Hey, that'll be nice. If we get the output of oil, right? Somebody's going to increase the output of oil. Somebody's going to do it. Somebody's going to increase the output of oil. And that's our biggest risk. Like I said, that's our biggest risk. If we get that increase, then oil doesn't go any higher from here. And hey, CPI goes to 2%, right? CPI now drops to 2. We know the Fed said that they're going to cut rates before 2%. They're going to cut rates as inflation falls. And the reason that is because you actually want inflation. You don't want negative inflation. You want positive inflation because that keeps growth up. You can't have economic growth without inflation. They're tied together. You just don't want inflation to get too elevated, okay? let me see, would you say I will always have my hands on oil stocks, have to be diverse while one's doing good? The other day. Yeah, I know you're bullish on oil. Big man's coming on energy stocks. I would say you want to be bullish on oil maybe when you're entering like February, March, possibly, or January, maybe in January, because you're headed into the summertime, right? So maybe that's the best time to be bullish on oil if the technicals are showing weakness in oil, right? It's always better to buy something when it's weak, not when it's strong. Buy it when it's extremely weak in the macro. But hey, what if we head to where there's less oil demand structurally in the world, right? Virtual economies, right? Not having to travel with planes to other countries. You're just doing virtual meetups, Zoom, whatever it is. And then also you get the, nuclear energy, you get solar energy. If the Tesla, I don't want to call it Tesla, but if the energy storage platforms start to really bring some progress where they can store solar, well, demand for oil is going to go lower. So I might disagree with you there when it comes to a long-term hold, but it's okay to have some of it in your portfolio, right? As long as it's not too big, because we know the secular trend of oil, the secular trend of energy coming from oil is going to go lower over time. Maybe it takes 5 years, but secularly, right, over the long term, there's going to be a lower demand for oil. So, maybe you're long, maybe you're long like a gas company or an oil company, not necessarily crude, because they're probably going to do some investment inside of solar. Dang, this oil chart does look very bullish though. You're getting that 50 start to cross above the 100. So that's of concern. We need output to increase for oil to come down. Fed liquidity. What's the term for what you just explained? You have a couple liquidity factors here. So there's so many different liquidity. Liquidity is basically how much cash is coming into the system versus exiting the system. And when I say into the system, I'm saying, is the Federal Reserve printing money? Is the U.S. Treasury printing money? And are interest rates in favor of sending capital into markets or into the economy, right? That's sort of what liquidity is. And it's just a term for basically how much money is being funneled back into the economy or back into the capital markets. That's basically what liquidity is. So you have a central bank liquidity, right? China, Japan. So their central banks can print money to debase their own currency. Usually when they print money, the currency falls. The currency will fall because they're debasing it. They're making it worth less. It's like you have a bottle of wine, right? The more you dilute it, the more water you put in it. That's like debasing the wine. The less quality the actual wine is. So you dilute the wine, it's worth less. You dilute the currency, it's worth less. But what you also do is you create more of it, right? If you put water inside a wine, now you have not 6 ounces, you might have 10 ounces. So you have more liquidity, right? But what it does is it hurts the underlying collateral, which is the dollar. So the collateral weakens, which is the dollar or the yuan or whatever it is, but you push liquidity out into the system, and that goes into risk assets, that goes into the economy, however it does. So I'm always watching the liquidity indicators. This blue one is strictly the Fed. This is strictly Fed liquidity leaving not Fed liquidity. This is strictly money market fund liquidity leaving the Fed and going into the economy. We've seen that reverse. It started reversing back in January, and that's when the bull market really started to break out. Okay, so that was kind of one for one. I'm trying to keep this simple. I know it's like a hard concept. And then if we take off that liquidity and we throw on Fed net liquidity, okay, this is really confusing, but this one's a little more muted. It's not really headed up because this accounts for the Fed balance sheet. So if we add the Fed's balance sheet, that's actually sucking cash out of the system. So yes, maybe there's liquidity coming into the system from the money market funds, but directly, I'm sorry, not from the money market funds. How do I say this? I'm going to make it simple. Stick with me here. So the blue line I had up there was, see where it is. Don't lose me here. Okay. This is cash from individual or institutions who are taking out their cash from the Fed. And when that cash leaves the Fed, it's either going in the capital markets or it's going into the economy somehow, usually capital markets. Okay. But this doesn't account the Fed balance sheet. When you add the Fed's balance sheet, right? Here's the Fed's balance sheet. That's going down. That's what this red liquidity is, which is, well, you might have positive liquidity, but you have negative liquidity from the Fed's balance sheet, meaning they're selling U.S. Treasuries onto the market. And the more Treasuries they sell, if you sell sell Treasuries to the banks, you get rid of U.S. Treasuries. The banks have to buy it with their cash, and they suck cash out of the system. So banks have to give up their cash to buy the U.S. Treasuries from the Fed. Therefore, you get negative liquidity. So the red kind of shows if you add everything together, we're kind of sideways. Nothing's really moving. Now, if you want to add the global central banks, right? You want to add the PBOC. You want to add the ECB. You want to add the Bank of Japan. If you add all of them together, global liquidity, well, they're also falling. So there's so many ways to measure global liquidity in general. Now, the one measurement we don't see, because all of them are kind of falling, the one that I say, hey, well, you know what's keeping markets up? Fiscal liquidity, right? Now, there's not actually a chart for that, but it's basically the White House creating spending, government spending. So government spending is fiscal liquidity, and I think that's been the strongest catalyst for the economy to stay up. The Inflation Reduction Act, the CHIPS Act, the infrastructure bill, that's what's keeping the economy strong. Therefore, possibly earnings in some areas and EPS in some areas. So it's tricky. That's why I'm here. Ask me questions. I'll try to answer you as much as I can. What do you think the Fed will cut based on CPI now? When do I think the Fed will cut? I'll say this. If oil gets back below 83.50, it's more likely for the Fed to cut. It could be end of year. It could be September, October, November, December. I mean, I really don't know. It could be 2024. They don't cut till 2024. So I'm not really sure when they cut. Pause. I think it's realistic that they could pause in the next meeting. I think that's very realistic. Given and that's going to be like CPI just didn't fall. You know, if CPI and PPI stay elevated above 3%, well, CPI in general, then maybe the Fed, pauses, but says, hey, we could hike again. So I really don't know. But here's the positive side to that. The higher interest rates are, the higher the Fed keeps those interest rates, the more individuals in the economy or, people who are holding cash, they're collecting earnings off their cash, right? So what are they going to do with that cash? They're either going to reinvest it in the market or they're going to spend it in the economy. So it's kind of a net neutral at this point. I think everything is pretty neutral, right? If the economy strengthens, well, that's good. But if the economy weakens, well, that's good because the Fed stops. So everything's kind of neutralized. And it really comes down to, the catalysts, right? AI, how does that increase productivity? When it comes to energy prices, will the, will where there'll be any increase in productivity? Will China start re-stimulating the economy? We just don't know. We just don't know, which is why we keep up with this on a day-to-day basis. Yeah, I mean that's pretty much it. I know there's some other stories out there, but I think that's what we're looking at here. Let me see if there's any charts that I'm missing. Here's a really good chart. I like this chart. This is M2 growth. So this is money growth from the Fed, the European Central Bank, the PBO. So the big powerhouse central banks. Everybody says the central banks are so evil. Let's add them all up and look at their liquidity year over year. It bottomed in October when the stock market bottomed, right? This is why I look at liquidity. It bottomed back in October when the stock market bottomed, when the crypto market pretty much bottomed out, even though ETH bottomed before Bitcoin. And it's been climbing up ever since. Okay, it peaked in January, pulled back, right? And the market kind of stalled in March, and then it started going higher. And that's when, the banking crisis happened. And we peaked in April, and then the market is stalling. We're at a stall point right now. The market is just cooling down. It's stalling. But as soon as this liquidity starts to turn back up, because we have a weak global economy outlook, right? As this liquidity starts to turn back up, markets are just going to turn back up because they move off of liquidity. It's really simple for the macro, but like intraday, week to week, month to month, it's way more complicated because you got to factor in how people are actually positioned, right? Are they positioned overweight, underweight? What is their sentiment? Did the data exceed their expectations or fall within their expectations, or was the data, worse than expected? So there's all these factors in the short term, but for the long term, right, it just comes down to, when is that liquidity going to come back up? That pretty much heals the markets, more liquidity. At the moment, you obviously see SPY moving up. So let's look at the intraday price action right now. What are we at? 111. We got about 20 more minutes. So throw out your questions if you have them. All right, I'm going to switch this back to the trading. There we go. All right, cool. And then let's get this down here. All right, so again, same thing, S&P. Look, and the RSI is coming down for S&P, or SPX. This is SPX. We're at the 50-day moving average. I know there's buyers stepping in here. Obviously, you see the buyers stepping in. SPX at this moment. So that's a net positive. But just to make it clear, Bukosi, when do I think the Fed will cut? I think it's going to come down to CPI getting to 2.5%, right? That could be in October, September. Yeah, that could be October, September. And again, that comes down to oil prices. So Bukoski, if oil gets rejected at 83.50 and it moves sideways, I'm going to say that inflation gets to 2.5% by September. What do you got? August, September, October. Yeah, September, October. That's what I think. If oil drops, okay, to 75, 70, then I think for sure September, that's when CPI gets to 2.5%. Will the Fed cut? Probably not. They'll probably just pause. So I'm talking about the pause here, not the cuts. But if oil goes up, then dang, they might hike again 25 basis points if oil keeps going up. So again, the cuts, I can't really call cuts because I want to see more data, more CPI data to really think about the cuts. It could be next year. It could be next year we get cuts. Now, hey, if there's a crisis, if there's some type of real estate collapse, it is possible the Fed does cut. Okay. But the market will need to pull back for that. So again, I don't know. I think we need more data. I think it's okay if they don't cut anytime soon because you're still getting investors collecting earnings or yield off of those rates, right? Rates are elevated. Yes. Does that hurt riskier assets? Yes. But it also creates fixed income for money market funds. It creates more capital, which really comes down to coming from the Fed. So it's funny because it's like they're tightening, but they're also easing at the same time. Right, so SPX pulling into that moving average. Let's see what the Qs are. NDX real quick. NDX, is it also? Okay, it's a little above. So yeah, NDX is a little above below the the 50-day moving average. So it's a little more weak, not as strong. Let's see what these overall trends look like. Nvidia's been the leader here. Nvidia looks like it's it dropped to 400. Buyers stepped in. Biggest green candle that we've seen for a while for Nvidia. I mean volume on the daily. This is the biggest volume since what? The breakout to nearly all-time highs. So you still have buyers stepping in here for these tech companies, big tech. We know AMD is consolidating. AMD just came off the lows, right? Oh, it made a new low. See, this is why I stayed away from AMD. I was like, it's looking a little shaky. So there is buyers. It looks like long-term buyers are coming into AMD. No traders. The traders are going to stay. It lost support. So the traders are not in there. But you do have buyers. So what I'm going to do is I'm going to clear this draw set because every support line pretty much got destroyed. We're still in the downtrend, right? So we can still draw this downtrend for AMD. Right? Still kind of wedging here. Boom. Still in a wedge. But you want to see some more support because that previous support just got violated. Went down to 105. Rates are just too high. All right, so that's AMD. Okay, Palantir. I know you asked about Palantir earlier. Palantir is finding a bottom at 15. The 15 level, pretty strong for Palantir. But rates are pretty elevated. They did have a pretty good earnings report looking forward. It's kind of shaky at this point. I think the market's just overbought. So like I said, you might have a good earnings report, but most stocks are pulling back, even though the earnings are pretty good. They're not terrible. They're pulling back because there's just a lot of profit taking place. I mean, Palantir, you know, where was it at the beginning of the year? Palantir was it the beginning of the year? Well, when it first bid up, I mean, it went up pretty much 160%, 150%, 160% from the last earnings report. So you're going to get a relief rally into the next earnings. And that's what we're seeing here. You're just looking for that support to come in and to trend higher for Palantir. Zoom has earnings coming up. I'm still holding Zoom, by the way. Didn't stop out. It's holding the trend. Okay. It's holding this trend, this uptrend. It's been holding this uptrend for a while. You see the RSI is, I mean, it's pretty consistent there. So I'm looking for Zoom to have its AI. We're getting some issues here. Oh yeah, we are. See, so Zoom earnings are coming up pretty soon. Let's see. Yeah, let's get through these technicals. Some of these technicals, see if there's any plays on here. Throw out your plays. Let me go to the restroom really quick, and then we'll do some more technicals. Throw out your tickers, and we'll look at the trend, right? We'll look at the trend and see if there's any opportunities. All right, so Zoom. I still like Zoom, like I said. When are these Zoom earnings coming in? Zoom earnings they're coming in. I know they're coming in soon. Let's see, where can I find the Zoom earnings? And then we got to take a look at crypto. But right now, no, I don't think so. Right now, crypto is all about regulation. And we're going to talk a little bit about crypto. MicroStrategy is finally pulling back. Oh, no way. Roku. Oh, no, that's the intraday. Okay, I was going to say, did Roku already come back? Already start to rebound? Pulling into the trend. Roku might be having a buying opportunity. Open door came back down to 340. PayPal is weak. All right, so Zoom earnings. Dude, why is it not showing the earnings for Zoom? I know I could look it up really quick, but I'm just trying to find it on the charts. I don't want to be looking it up. There they go. That's weird. Okay, so it wasn't showing up on my chart. Now it is. So Zoom has earnings. Dang, the 22nd. So we still got a while. I'm hoping that the market finds a bottom by the 22nd of August. So at least has the overall market catalyst in play for Zoom. That's what I'm hoping. That'll be nice if you can catch the overall market start to turn up at the same time that I think they're gonna have a positive earnings report, just like most of the stocks. They'd have to have something really bad to happen. So that Zoom. We'll take a look at Teladoc. Teladoc just doesn't want to go higher. Right back to support. So getting smashed. Right back to support. But this has been a strong support for Teladoc at 23. You need the overall market to really get crushed for that support to drop, I would say. Oh, yeah, Michael Burry, 93% short. Man, he says I don't know if I believe that guy. He's been wrong this whole last couple of years. He could be short positioned and then just cover his position. So it's a lot of attention. It's media, whatever. Michael Burry, he was right in 15 years ago. So, oh, thanks. Earnings 821. Okay, I showed me 22 for some reason. Who knows? But yeah, looking out for those Zoom earnings. Teladoc right back to the lows. You could add here too for Teladoc. That would be a really cheap contract 2025. The risk is the market just doesn't bounce. But again, not IBB. What is the XLV? XLV is the healthcare ETF. Okay, and the healthcare ETF is trending higher. Right, healthcare ETF is trending higher. So I have confidence, and we are coming into resistance zone, but I have confidence that healthcare will move up over the next over the next 6 months. Healthcare still moves up as a sector. It's been pretty weak. So if you get the breakout in healthcare, that's going to be really good for Teladoc for the short term. So you have that. You have IBB, which is biotech ETF. That thing is still lagging. The biotech ETF is still pretty much lagging. The correlating stock, my favorite correlating stock would be CRISPR Therapeutics. Ooh, that thing dumped hard. Wow. Wow, it dumped pretty hard. Buying opportunity? I don't know. I wonder what happened there. Those biotechs are tricky. You're really taking a risk with biotechs. Okay, so what else we got? Open door is something we're looking at. Still grinding higher. pulling back into, it looks like there's a lot of support here for open door at what is this at, like 350, 350ish. It's trying to hold the 350 level. So some of you guys, when you get a big move in open door, I know Asan or some of you are holding open door, I would say, could it go higher forever? Yes, but you want to look at the overall market. If the overall market shows a lot of weakness, then it's very likely that these are going to be weak. So stuff like open door are gonna follow. It got smashed. So you could trade it, or you can just wait for it to return and then start adding it to your position if you think the fundamentals are strong. I don't really know how great the fundamentals actually are, so I would more so trade this open door. And when I say that, I'm not an expert on the real estate like Zillow and all that. I don't really know who's ahead. I don't look into that. I'm more interested in tech. So anyways, open door is pulling back into that 350 level. That's a big level. Look at all this capitulation though, right? You're seeing the capitulation. So obviously there's some buyers holding it up here at that level. So that's not bad, but we need the overall market in our favor for that continuation to happen. What else do we have? WTI. I think people are trying to trade WTI because it's a cheap oil derivative. Looks like it bottomed out. It's going to go higher. But again, this all has to do with oil prices. So WTI alone means nothing. You need to watch crude. Just got to watch crude oil to figure out how that's going to go. All right, let's see. Also, we have Okta. Okta looks like it's turning up. These are all tech too. I'm looking at a lot of tech stuff. Let's see, what is the other plan? Oh, you know what we haven't looked at was at Oracle. Yeah, keep your eye on Oracle. So Oracle MicroStrategy with the bounce at 360. I didn't even see that. Oracle MSTR. Dang, ENPH has made another new low. Carvana, is Carvana finally starting to get smashed? Maybe higher low. Yeah, Carvana looks like a short. So CVNA, I don't know if people want to short Carvana, but that could be a nice short. Coin all the way back to the lows. Adobe. So let's look at Oracle and no, Airbnb broke out too. Oracle, Adobe. Yeah, let's do Oracle, Adobe, and maybe some Roku. Yeah, Oracle looks really good. So Oracle was at all-time highs. This is obviously more so for trading. If you're investing, I mean, just hold it. But Oracle has a pretty sharp pattern here. Pretty sharp pattern. A lot of clarity. This is a descending flag pattern. Okay, it has a narrative. This is an AI picks and shovel type play. Big cloud computing. So, well, actually, you could call this a wedge, a falling wedge. Had some juice today. Yeah, that's a big wedge there for Oracle. Looks like Airbnb pulled back significantly to that 50-day moving average. A lot of stocks are coming in the 50-day moving average. Who cares? Let's look at Tesla really quick. Okay, so Tesla on the other hand is just trending up. Okay, still trending up. So let's take this trend. Okay, kind of points us at the man, this thing is slow. Kind of points us at the trend supports around 230, 235, 230. Filled the gap at 235. Got a little below it. And then it came right back up. So you have the 100 moving average. Also the RSI, I'm keeping the eye on the RSI. So the RSI is almost oversold, right? Once it gets oversold, a lot of technical traders will just come in because, you know, Tesla oversold is a great trade opportunity. And that might be, you might just want to wait for it to get oversold. A lot of people will look at it, even if you're just investing in it. You know, Tesla attracts a lot of traders. It has the most options activity of any other stock, almost by far, I believe. So oversold signals are very strong for Tesla, and it's in a very sharp descending wedge or flag pattern, whatever you want to call it. It's very sharp. So it could have one more upside move and then, another upside move and then down one more time. I'm thinking it goes up and then it comes down one more time, or this could be the bottom. It could be filling that gap and that's it. Depends on the overall market. Disney, DIS, we'll take a look at Disney. A lot of people like Disney, huh? All right, Disney. Disney just has a really strong support at, Disney's a blue chip name. It's one of those blue chip names. I don't think Disney's going anywhere. I still see a lot of support between 87.50 and about 85. So really, it's just, that's where you stop out under 85. But Disney looks good. It's trying to hold the 50-day moving average, so it's trying to hold, but it did break out of the immediate wedge here. The RSI is starting to climb. Yeah, it's been in a bullish divergence, so Disney pullback is just the overall market weakness. I think, is Disney consumer discretionary? It could be under consumer discretionary. But yeah, Disney has a pretty strong bottoming pattern there. I don't know if right. Oh, Rad. Oh, Rad probably has that trading opportunity, huh? Because I know Rad. It's like, who's investing in Rad? Let's see, Rad. Big short squeeze into the 200 moving average for Rad. Coming back down. Will it find support? Well, looks like your support on Rad is about what? What is this? 2? I would say $2. If it can hold $2, that's always a big psychological level as a whole number. $2. If you see the bounce off 2, get your stop right under 2. Get your stop right under 2. So let's go a little lower here. Yeah, I got to 198. This is pretty much it. $2. Yep, RAD, the bounce off of 2 could be a low. Under 2, it's probably going to get crushed and fill the gap all the way back down to what, 150? 170? Yeah, so 2 is that level for RAD. I'll would say under this, that's it. That's your level. It'd be a nice trade. What else you got, Hassan? And then see, at the moment, Qs are turning up. Let's take a look at those. Oh, the Qs look solid. Wow. Intraday, the Qs are forming a very, there's a lot of buyers above VWAP. So Qs have a lot of strength today. SPY holding VWAP also. IWM holding VWAP. I'm sure the Dow is. I just can't see it on here. Oh, my bad. You're asking for the short. My bad. The short on RAD. Well, the hold is $2. So anything below 2, or you know what's even better to short RAD? If you see it fill the gap, it couldn't do it, but if it gets below 2, I would wait for a rejection. So I wouldn't just get short right under 2. If you get the perfect setup where it leaks below 2, and then it comes back up, right? Maybe intraday, and then it retests somewhere around 2. That's where I'd get short. And then you're anticipating it to fall. So breaks 2, comes back up, retest around. It doesn't have to be perfect, right? It doesn't have to be a perfect test at 2 point exactly, just somewhere in the zone. And then your stop is a hold above 2. So I think that's the only thing I could see there. Also, CVNA looks like it lost its steam. Carvana could be the short. This could finally be rolling over, especially with global liquidity weak in the market. Carvana could be stalling out here. You might, for the first time, be getting the 50-day moving average trading below the 100 daily moving average. This is a 4-hour chart. We haven't got the 400. Oop, that's bad. You haven't seen the 50 cross, the death cross, right? The 50 below the 100. We haven't even got that this whole cycle. So let me see. Last time we had that was, I mean, that was like a short move. But yeah, the 50-day has been holding for about 3 months. Man, Carvana got down to 62. Or got up to 62. That's crazy. I don't see any entries though. You want to see a gap down here. What's up with Target? Let's see what Target looks like before we get out of here. Target right back at support. Ooh. Okay. Yep, Target right back at support. Guess that's what we're seeing for the short term. If Target falls 130, gets below 130 and holds, it may just go back down to 115, 125. I'm sorry, 125. Yeah, 125. It's a mute market. Just keep your eye on the, like, find something that, if you're trading, right? If we're talking investing, I mean, just buy the dip. But if you're trying to figure out what's going on in the market, I definitely think that the Qs and the SPY are trying to find a reason to find a bottom. So the 4-hour is very bearish right now. Okay, the 4-hour chart is very bearish for the Qs, possibly for the SPYs too. You go to the daily chart, also pretty bearish. Looks like the Qs want to go lower. But they are pulling into a previous support, which is about 365-ish. We're holding the 365 level. You also want to see this downtrend break for the Qs if you're talking big tech. But I think we still have market breadth. So that's the Qs. That's technology. If you go over to the Dow, which your trades or your stocks might be like Caterpillar, Deere, Visa, Dow looks good. The Dow looks really good. Okay, there's Caterpillar. Yeah, Caterpillar looks like it's forming a wedge. Yeah, Caterpillar sort of wedging, so does it hold up? I don't know. But you got a nice wedge on Caterpillar. Visa, DE. See, Visa's grinding up. Okay, nice. Just looking at Visa, DE. So market breadth is still here. You still have market breadth. Visa, who's this? John Deere. John Deere grinding up, looking to break the highs. Hey, Deere could make a big move over 450. So that could be a nice move on Deere. I think they already had earnings. Deere over 450. You're starting to get also on Deere the golden cross. So the Dow stocks, I'm guessing, are a little strong today. A lot of market strength. I got Rivian too. Okay, you got the Rivian. What is Rivian's ticker? I always struggle. Oh, okay, Rivian with the big pullback. Rivian's pulling back in at about 2050. Okay. Definitely want to get the hold at 2050. VZ, Doug. So I'm guessing VZ, you're looking for the dividend, right? The dividend yield. I think Verizon has a really good dividend yield. It's known for its dividend yield. I mean, hey, if you want to get a dividend company, I always say make sure you're buying it at the lows. You're buying at the lows because then your dividend at least will only increase over time. Structurally, is Verizon going to survive, right? Are they going to survive the Starlink? Because Verizon looks like trash. Holy smokes. This thing just keeps... That's the problem with dividend stocks too, is that the really fat dividends may have some, some structural issues here. If this stock keeps selling off, you never really make back your dividends. You're just getting dividends, but the underlying collateral, which is the stock itself, is down. So even if you got in at the bottom of the market last year, you're down 30% on Verizon collecting all these dividends. So you really need Verizon to recover back to like 50. But I would say Verizon looks extremely weak right now. It looks like it's going to keep downtrending. I'll tell you that. Verizon looks like it's going to... I think a lot of these telecommunication services are going to keep downtrending. They have bad debt. They have really bad debt. I don't know what to say, man. That's all I got to say about Verizon. I'm not a fan of these because I think they're getting disrupted right now. If you're already in it, I mean, just hold. Wait for the overall market to really bid back up. If you're looking to get in it, I would say no on Verizon. If you're looking to get in Verizon, I would say no. You just don't know. But if you're already in it, you just got to wait it out at this point. Just got to wait it out and collect those dividends. Doug. Q's moving up pretty sharply. That's solid. Okay, we go to Palantir. Yeah, so let's switch over to crypto really quick. We'll switch over to crypto. And then we'll end it there. Roku looks pretty good. All right, so starting with Bitcoin. We have a lot of stuff on here. Let's see, are we on the log chart? Always got to make sure you're on the log chart with crypto. So Bitcoin is at support, at trend support. So it's at trend support. It's kind of lackadaisical. But if you take a step back, I mean, let's take a couple steps back here for Bitcoin. You see we're at the beginning of the cycle. All right, we're at the beginning of the up cycle. So we need to get above the probably like 32,000. 32,000 and it kind of looks like it did back here, right? Back in 2019. Was this 2019? I think it was 2019. Oh no, 2016, my bad, 2016. 2019 was over here. All right. So I think we're at the beginning of a new cycle. Once you clear those moving averages, this is the weekly moving averages. Once you clear those moving averages, you really get the upside cycle. And this is all going to be determined on the Fed or the global, really not just the Fed, but global liquidity turning up. So Bitcoin is very much correlated to global liquidity. And this might be the bottom for Bitcoin. This could be the bottom. 25K maybe comes back into 25K. It's very strong support there for Bitcoin at 25K. Ethereum also looks pretty solid. I think Ethereum already broke that downtrend, moving sideways right into the trend. So Ethereum's coming right into the trend. Man, these things look weird on here. Let's go to ETH to BTC. So this is ETH versus BTC. Still wedging, waiting for regulation. That's all you're doing. You're looking for regulation there. But I think this is the bottom for crypto. All right, so real quick recap. Okay, quick little recap here. Look, inflation is still making progress. Okay, the easiest signal is the dollar. The dollar's pulling into trend as we speak. Okay, it is pulling into the trend at what, 103.50-ish? So we need the dollar to weaken. Remember the RSI. Okay, the RSI is on the daily RSI is at resistance. The weekly RSI is not really overbought yet, but here's where it's been getting resisted at. Okay, maybe we're wrong. Maybe it breaks out all of a sudden, but we still have weakness on the daily dollar RSI. So I'm looking at the daily RSI for the dollar, and it looks like it's coming into resistance. Okay. Also, the oil market, which is going to determine the next 6 months, it is bearish, right? Very bearish, and we know that yes, supply is getting cut at OPEC, but that's because demand is falling. So it looks like oil, oil cannot hold so far above that 83 level, 83.50 level. It's not able to hold. So this is showing us weakness. In the short term, we're seeing that, okay, oil's not getting above 83.50, right? Could that change? Sure. But we're getting bearish divergence. We're going to keep our eye on day-to-day news and whatever else comes out. Okay. Another big risk is that, bond yields, 10-year yield, the benchmark yield for the bond market is breaking out to, well, today it got to levels we haven't seen for what, 6 months? Yeah, 6 or 7 months. So bond yields are bidding up. Now, is there a reason for bond yields to really just break out? No, inflation is not ripping higher. So either these guys are anticipating that inflation reaccelerates, or they're playing off, they're trying to front run the growth data for this week, which growth doesn't mean yields go higher. It has to be the Fed saying we're going to keep hiking rates. So Fed speak on Wednesday, retail sales tomorrow, but Fed speak on Wednesday, the minutes, right? We get the minutes coming out, and we'll see how the bond market reacts to the minutes. I am worried about this though. This is a big risk. The bond yields keep going up. It's going to hurt valuations for stocks for sure. Okay, it's going to hurt valuations for stocks. And VIX isn't really moving, so I think a lot of this weakness is just a pullback in the market. A lot of cash on the sidelines still. Nobody's too worried, or else we would see the VIX really starting to spike. We're still getting market breadth also, right? Dow is bidding up. IWM's kind of trading sideways. So yeah, that's about it. 3 minutes to the close. I think we're going to start doing these closer to the close. Qs are moving up into the close also. We got the Qs bidding up into the close. The narrative might just be that actually I got to check the narrative. We haven't really looked at what the market is saying at this point. See, oh, do I have CNBC up? No, I don't. Okay, stickier inflation. Stickier inflation. You know, at this point, it makes sense that the economy might actually be stronger than the stock market because higher yields hurt the stock market because they're valued off of yields going forward. But that actually helps people who hold treasuries or hold cash because they're collecting those yields, which means the economy will continue to strengthen, where stock valuations actually might weaken, which would be a weird situation. It'd be a weird situation. But is that really realistic? I think what's more realistic is if the Fed is going to end the hiking cycle this next meeting, and if oil comes back down, inflation, then all that cash on the sideline just comes back into the market, especially with the economic backdrop of GDP still going higher. So we just need more liquidity. We're looking at levels here. The market is falling into levels, and there's a lot of support. Nothing to really freak out at. I think, again, your biggest indicator here, on a day-to-day basis is where's oil at? Is oil above or below 83.50? Where is it going? That's going to determine a lot, right? If oil drops significantly, those yields will come down. They have to. They'll have to come down. There's no bet on inflation reaccelerate. Everybody knows inflation only went up because oil jumped 20%. So it's all about crude oil. Keep your eye on crude oil. That's all I really have to say for the rest of the day. I do appreciate you guys jumping on. I'll be on again tomorrow. My schedule's a little off. I don't have exactly what I'm doing. I'm still down here. I am now an uncle, so that's nice. I'm going to go visit my nephew here a little later today. So, I won't be back on, great schedule. I'll let you guys know what I'm doing with the schedule going forward. Other than that, like I said, I appreciate you guys. Stay blessed. Get your exercise in. Eat a healthy diet. Improve every day. Keep your mindset strong. Okay? Thank you guys for joining, and we will catch you later. Don't forget to sign up to the newsletter if you're not signed up, so you can get the technicals, the macro. All right, guys, stay blessed. We're getting a big push on the Dow, wow, at the end of the day. So guess we'll see what happens from here. Let me get the music on too, in case you're just listening. Get some celebration music. Stock market ended strong.